Greetings and a warm welcome to Finantax Clips. We're your go-to hub for decoding the complex world of finance. Today we're going to unravel a topic that often goes unnoticed, the hidden danger of credit limit increases and high credit utilization. We'll be shedding light on what these terms mean, their potential pitfalls, and how to navigate them wisely. So, if you've ever wondered about the intricacies of credit limits, you're in the right place. Stay tuned as we delve into the intricacies of credit limits and their hidden dangers. Before we dive into the risks, let's first understand what a credit limit increase is. A credit limit increase is simply an adjustment made by your credit card issuer to raise the maximum amount you can charge to your credit card. It's like a vote of confidence from your credit card company. They're saying, "Hey, we trust you with more of our money." It can feel like a pat on the back, a nod to your financial responsibility and reliability. So why do credit card companies offer these increases? Well, it's a win-win situation for both parties. For the credit card company, a higher credit limit means you have the potential to spend and therefore owe more, which can lead to more interest income for them. For you, the cardholder, a credit limit increase offers several benefits. First, it provides more spending power. Whether it's for an emergency, a large purchase, or just the convenience of not having to use multiple cards, an increased credit limit can prove quite useful. Second, a credit limit increase can potentially improve your credit score. Credit utilization, which is the percentage of your available credit that you're using, plays a significant role in your credit score calculation. By increasing your credit limit, you lower your credit utilization ratio, assuming your spending levels remain the same. This can make you more attractive to lenders, as it signals that you're not maxing out your available credit. Lastly, it can serve as a safety net. If an unexpected expense pops up, having that extra credit can save the day. It's like having an umbrella handy for a rainy day. You may not need it often, but when you do, you're grateful it's there. But remember, there's no such thing as a free lunch. With these increased limits and potential benefits come responsibilities. However, with these benefits comes a hidden danger that we need to be aware of. It's easy to overlook the potential pitfalls of a higher credit limit, and that's what we're here to explore. So, stay tuned as we unveil this hidden danger in our next segment. Now that we understand credit limit increases, let's unveil the hidden danger: high credit utilization. High credit utilization is the percentage of your credit that you're using compared to your total credit limit. For example, if you have a credit limit of $10,000 and you've used $3,000, your credit utilization is 30%. This is where the danger lies when your credit limit increases. With a higher credit limit, you might think you have more money to spend, but don't be fooled. It's not extra cash, it's borrowed money. And the more of it you use, the higher your credit utilization. This is a red flag for lenders and credit bureaus because it suggests that you may be relying too heavily on credit to meet your financial obligations. The impact of high credit utilization on your credit score can be severe. Your credit utilization ratio accounts for nearly a third of your total credit score. So, if you're consistently maxing out your credit or even just using a large portion of it, your score could take a significant hit. Think of your credit score as a financial report card. Just as your grades reflect your academic performance, your credit score reflects your financial responsibility. High credit utilization is like failing a major exam. It can drastically lower your overall grade, or in this case, your credit score. This can lead to a domino effect of financial consequences. The lower your credit score, the less attractive you are to lenders, which can make it harder to get approved for loans or credit cards in the future. It can also lead to higher interest rates on these loans and cards, meaning you'll end up paying more in the long run. So, while a credit limit increase can provide more financial flexibility, it can also lead to high credit utilization if not managed wisely. This is the hidden danger that many people overlook. Understanding this risk is crucial to managing your credit effectively. And remember, credit is a tool, not a crutch. Use it wisely, and you can build a strong financial future. But misuse it, and you could find yourself in a financial pitfall. Let's delve deeper into the impact of high credit utilization. Now, when it comes to credit utilization, it's not just a number. It's a reflection of your financial health. And like any reflection, it can be beautiful, or it can be a little scary. High credit utilization, unfortunately, falls into the latter category, and here's why. First off, it can lead to lower credit scores. Credit utilization makes up a whopping 30% of your FICO score, the most widely used credit scoring model. If you're consistently using a large chunk of your available credit, it can signal to lenders that you're a high-risk borrower. This can result in a lower credit score, which can affect everything from your ability to get a mortgage to your insurance rates. Next up, we have higher interest rates. When your credit utilization is high, lenders may see you as a riskier bet. And to offset that risk, they may charge you higher interest rates on loans and credit cards. This means that every dollar you borrow could cost you more in the long run. It's like buying a coffee and finding out you've been charged for a gourmet latte. Lastly, high credit utilization can lead to difficulties in obtaining future credit. Lenders want to know that you can handle the credit you already have before they give you more. If you're maxing out your current cards, it sends the message that you might struggle to pay back any additional credit. This can make it harder for you to get approved for new credit cards, loans, or even something as simple as a mobile phone contract. So it's not just about the here and now. High credit utilization can impact your future financial endeavors too, creating a ripple effect that extends far beyond your current situation. It's like a pebble dropped in a pond. The initial splash might seem small, but the ripples spread far and wide. As we can see, high credit utilization can have far-reaching consequences. Now, this might all sound a bit daunting, but don't worry. There are ways to manage your credit utilization, and we'll talk about that in the next scene. So, stick around. Now that we've identified the risks, let's talk about how to manage credit utilization. It's essential to remember that credit utilization is a significant part of your credit score, and it's one of the few factors you can control. Let's dive into some effective strategies that you can use to keep your credit utilization rate in check. Firstly, the most straightforward approach is to pay off your balances in full each month. This is a powerful way to keep your credit utilization low. By paying off your entire balance each month, you are effectively resetting your credit utilization to zero. This is a strong signal to credit bureaus, reflecting responsible credit behavior. However, it's important to note that this strategy requires careful budgeting and financial discipline to ensure that you don't overspend. Secondly, maintaining low balances on your credit cards is another effective strategy. This means not maxing out your credit cards and keeping your spending significantly below your credit limit. Ideally, you should aim to keep your credit utilization below 30% of your total limit. For example, if you have a credit limit of $10,000, try to keep your balance below $3,000. This shows lenders that you're not overly reliant on credit and can manage your finances responsibly. Next, avoiding unnecessary credit limit increases can also help manage your credit utilization. While a higher credit limit might seem appealing, it can lead to increased spending and subsequently a higher credit utilization rate. Therefore, unless you're confident in your ability to manage your spending, it may be best to decline credit limit increase offers. Another strategy is to increase the number of credit accounts you have. This might sound counterintuitive, but having more accounts can actually lower your overall credit utilization rate, providing you manage them responsibly. This is because your credit utilization rate is calculated based on your total credit across all accounts. However, remember that opening new accounts should be done sparingly, as this can also impact your credit score. Lastly, consider setting up balance alerts with your credit card issuer. These alerts can notify you when your balance is nearing a certain limit, helping you keep track of your spending and prevent you from crossing your desired credit utilization threshold. Remember, managing credit utilization is a balancing act. It's about understanding your financial habits, setting realistic goals, and making informed decisions. It's not about completely avoiding debt, but rather managing it in a way that works for you and your financial health. So, whether you're just starting on your credit journey, or you're an experienced financial enthusiast, These strategies can help you maintain a healthy credit utilization rate and ultimately a strong credit score. By following these tips, you can avoid the hidden danger of credit limit increases. To better illustrate these concepts, consider this case study. Let's call our subject for this case study John. John is a 30-year-old professional who has been using his credit card responsibly for the past 5 years. He pays his bills on time and hardly exceeds 30% of his credit limit. One day, John receives an offer from his bank for a credit limit increase. They offer to double his credit limit from $5,000 to $10,000. Excited by the prospect, John accepts without fully understanding the implications. In the first month, John continues his usual spending habits, maintaining his credit utilization below 30%. However, with the increased limit, he feels a sense of financial freedom and starts making more significant purchases. His new credit limit emboldens him to buy a new top-of-the-range television, upgrade his phone, and even take a spontaneous weekend getaway. By the end of the second month, he has used up 70% of his credit limit. Now let's pause for a moment and look at the impact on John's credit score. Remember, credit utilization accounts for almost a third of your credit score calculation. By using 70% of his credit limit, John has significantly increased his credit utilization ratio. His credit score takes a hit, and he is now considered a higher risk to lenders. Unfortunately, the effects don't stop there. John's high credit utilization also signals to lenders that he may be living beyond his means. This perception could affect his ability to secure loans or get good interest rates in the future. Despite the increase in his credit limit, John's financial health is now worse off than before. Moreover, John now faces the challenge of paying off his credit card debt. His monthly payments have significantly increased due to his higher spending. If he only pays the minimum amount due every month, he could be stuck in a cycle of debt for years, paying more in interest than he initially spent. This case study of John is a cautionary tale that underscores the importance of understanding and managing credit utilization. It's not just about how much credit you have, it's about how you use it. While a credit limit increase can provide more financial flexibility, it can also lead to high credit utilization, negatively affecting your credit score and overall financial health. Before accepting a credit limit increase, it's crucial to consider how it might impact your spending habits and credit utilization ratio. Remember, maintaining a low credit utilization ratio is key to a healthy credit score and financial stability. This case study underscores the importance of understanding and managing credit utilization. Today, we've taken a deep dive into the hidden danger of credit limit increases. We've journeyed through the intricacies of credit limit increases, uncovering their potential pitfalls and how they can lead to high credit utilization. A credit limit increase, as we've discussed, is an increment to the maximum amount that you can owe on your credit card at any given time. Lenders often offer these increases as a reward for good financial behavior, but they can be a double-edged sword. We then unveiled the hidden danger lurking beneath these increases, the risk of high credit utilization. This is the percentage of your available credit that you're using at any given time. The higher this percentage, the greater the danger. High credit utilization can give the impression that you're reliant on credit, which can tarnish your credit score and make it harder for you to secure loans in the future. We also explored the impact of high credit utilization. It's not just about a lower credit score. High utilization can lead to increased interest rates on loans and credit cards, and even affect your ability to rent a home or secure a job. It's a domino effect that can knock your financial stability off balance. But it's not all doom and gloom. We also delved into how you can effectively manage your credit utilization. It's about being mindful of your spending habits, making regular payments to keep your balance low, and not being lured into the trap of spending up to your increased limit. We've also shared a case study to bring all these points home, demonstrating the real-world implications of high credit utilization. It's a cautionary tale that underscores the importance of managing your credit limit increases wisely. In conclusion, while credit limit increases can feel like a financial win, they must be handled with care. High credit utilization is a hidden danger that can unravel your financial health. But with mindful management, it's a pitfall that can be avoided. So, as we wrap up, remember to keep these tips in mind. Be aware of your credit utilization, manage your spending, and tread carefully with credit limit increases. Thank you for tuning in to Finantax Clips. Remember to subscribe, share, and like our video. Until next time, stay financially savvy.